Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, December 3rd, 2025. It is 11:37 a.m. Eastern Time, so I'm starting the video. And what I'm going to do in this one is a brief update on the markets like I usually do, and then just a potpourri mix of various trade ideas. I'll do updates on some of the existing trades like natural gas, Bitcoin, and the proxies, as well as some new ones that I've come across, some that I've shared with you, and some that I haven't yet. All right, so we started the morning with ADP. Remember, the government's still kind of trying to get back online. A lot of the, even though the government is back online, a lot of the reports are missing data. So the market's been really looking at ADP. Just a lot of volatility today. They missed by a mile. They were looking for a gain of, I forget how many thousands of jobs, and it was actually a loss of 32,000. And this is the chart right here. You can just Google search, ADP employment chart. We're these are, I don't know if you can see it because I can't change the color. They're yellow, but they're negatives. You can see the negative value. You can see the clear trend. The market's in that bizarre world. It's done this before. It's not the first time, but where it rallies that bad news is good news. Good news is good news, and bad news is good news because bad news means the Fed's going to cut. If you're new to the site, and I apologize, I didn't have it queued up, I can, and I encourage you to do it. You know what? Let's just do it. Let's just show you this chart because I haven't done it in a while. Let me throw up a new window here. This is it. This is the federal funds rate. It seems like probably the I don't get it. Anywho, the shaded areas are recessions, okay? And as you can see, this is as far back as I can go here. And this is straight from the horse's mouth. This isn't any kind of, bear blog like, Zero Hedge or anything like that. This is straight from the Federal Reserve. Federal Reserve Bank of St. Louis, Fred is the name of their website. And so you can see all the recessions. COVID was quickly over. Again, it was what I call Ursa Interruptus. You have enough. They hit the all-out nuclear button. We all know what happened at that point in time. So they were able to change the trajectory of financial markets by printing ungodly amounts of money around the world and stimulus. So that's it. So the point is that rates go up. And once the Fed starts a cutting cycle after a hiking cycle, usually like right here, they plateau for a while, then they cut. They rise on a rate hiking cycle, plateaus, then they start cutting. And again, the pattern is, it's there. There it is, plateau after rate hiking cycle, cuts. Plateau after rate hiking cycle, cuts. Plateau after rate hiking cycle, cuts, and even happened with COVID. I've covered it many times. There was a bear market and a recession built into the charts. It happened. It just happened so fast due to the over the panic that all the global central banks. It wasn't just central banks. It was also the fiscal stimulus as well as monetary. And there it is. Okay, so the cycle repeats. Recessions are declared, at least the official ones by the NBER. I'm sorry. National Bureau of Economic Research, and they are always declared in hindsight. So they will populate at some point shaded areas again after the fact. And again, you just analyze this chart, you study it on your own. The only reason they're going to be cutting, and they are cutting now, is everything that's happening. The employment job market, which is everything. Consumer spending generally accounts for 70% of GDP. They say recently that's been overshadowed by AI spending, so very unusual. But again, so take that for what it's worth. So that's where we're at. And guys, this happens every time. Remember, the market and the economy are not the same. There is a lag time. And ultimately, we can look at employment as well. Something I have done many, many times on this site. And again, I'm lost as to how it happens. I know there's a lot of things out there, and I could sit and talk on the dynamics of the market, all the liquidity that was pumped in after COVID, and how the Fed kept the pedal to the metal way too long. And so you still have a lot of that liquidity sloshing around. And then I've read the amount of stock trading volumes increased drastically. They say, I was just reading today, I think it's like, oh God, what is it, 80%? It was well over half of the brokerage accounts open in the last 5 years were open from Robinhood. You got these, and I know some of you listen to my voice are younger than me, and don't take offense, but these are newbies to the markets. They've never lived through a bear market or recession. They don't have a background in, fundamental analysis, economics, and all that. They're just trading stocks, and they're helping to support this AI bubble and the hype and everything. And it's a vicious cycle. Stock market goes up, wealth effect goes up, more people spend money. But this is the other one. And again, when I look at this, sometimes it appears that I'm the only one in the world seeing it. But again, I've traded enough market cycles to know that creates opportunity, because just like at the end of a bear market, as I said the other day, valuations are way too low and they're pricing in doom and gloom that it's going to go down forever. And those are great buying opportunities. Same thing at the top of a bull market. Prices get way ahead of themselves. And if you're a flexible trader and willing to short, you can make a boatload of money. And so that, again, it's here. This is economic. This is fundamental analysis or macroeconomics. And so at every point in time, there's especially in recent years, but there's about a low end of unemployment. Again, this is the federal unemployment rate. I can maybe zoom it a little higher for you. And again, guys, this is pretty easy stuff, right? You're never going to go down to zero, right? That would mean every single person in the country has a job. That's never going to happen. So there's a floor, and it's a pretty low floor, and it's, especially in recent years, this is about the floor. You can see right in this range. So we've hit the bottom of that floor again in recent decades. We're talking going back, 3/4 of a century, really. So I think we can all agree that's troughed. And then more importantly, guys, and again, as I've covered this, there's a turn up. These are what I call little micro blips, within a trend. But once a trend clearly changes, you don't have to be an expert technician to see when they've inverted. And again, and it's more than just a blip. This is a clear inversion, right? This is a clear trend change. And I beg you, implore you to just study this chart. It doesn't take long. At no point in time have you seen such a clear and unmistakable trend change, no blips, and had it, go back down and stay low. In other words, you always V-bottom. You've never come down and stayed down for years on end at this historical low rate. So, and then what happens again? This is where opportunities lie, and we got to, we'll get the timing right. I have my long-term outlook, long-term targets, and then the short-term charts are going to be our guide to get in, out, manage positions, even longer-term swing positions. You can use the daily and 60-minute charts on, but there it is. And then ultimately the recession follows, right? It only makes sense. You got to have enough people to lose their jobs to finally start seeing that delayed impact of reduced consumer spending. And it's a vicious cycle. And again, it's one in history that is really almost, at least historically, once that trough is in, that's it. You go up, unemployment continues to rise. It's a vicious cycle, if you will, and that's it. So it's not the end of the world. Recessions are a very natural part of the business cycle, and what happens, and the Fed has done their damnedest, especially since the financial crisis, to prolong and stave off recessions with excessive easy money policies. And as obviously you can see what happened when COVID hit. And that's not natural. The analogy I use is prescribed burns. The forestry department here in Florida and California, Arizona, those dry states. We have a dry season in Florida. We have a wet season, which is like monsoons, but then a very dry season. And we do those prescribed burns as well, because if you don't, once the rainy season starts here with the thunderstorms, a lightning strike, campfire, it'll take down the entire forestry area where it happens. 100-year oaks and all will come down with it because of you allow the underbrush to grow, all that fuel or tinder, if you will, for the kindling, whatever you want to call it, for the fire. And so that's what the Fed's created here, and they keep trying to, squash down any fire, stave off recessions, which again is going to set the stage for just a much bigger one. So That's it, guys. So there it is. And the million dollar questions, how much longer? And again, you can look at historically, we're about there right now. And again, these, the shaded gray area will be populated. And I wouldn't be surprised if it were already, again, in hindsight, when BER finally does come in and declare, most likely, my guess is probably going to have started this quarter, Q4 2025, or no later than next. Again, based on my fundamental macro analysis, this is where we're at. Okay, and all that means virtually squat to an active trader. I don't care whether we're in a bull market, bear market, deer market. Active traders are going to trade the short-term chart. So we'll start here. This is what I gave you this morning in pre-market. If you move fast, you made a quick about 0.75%, I think, said and done so far on that first drop. Yeah, 0.82, whatever. A little kickback rally, giving you an opportunity to re-enter back in. And we have a little bit of resistance here. So you can see this is a little support shelf that broke with this little trading range. So here, maximum will be a back test of the trend line, but I doubt we'll get there. This was a breakdown of a nice clean wedge. This wedge, I gave it to you on a 15-minute chart this morning. But it shows through on the 60-minute chart as well. This is NQ, same thing, NASDAQ 100 futures, but on my hourly chart. We went up to a little stretched on the kickback rally off. Remember, we shorted here, gained some bounces along the way, and hit the sixth and final target there. Went a little bit deeper, just like back here. We had a short entry there with 2 targets given. We went a hair below that last one. Again, it's kind of like the Bitcoin trade. Sometimes I'm lucky enough to milk every penny of a run. But, like I said earlier in today's post, bulls make money, bears make money, hogs get slaughtered, or pigs get slaughtered. And so quite often my targets are going to be set a little shy of where a move is likely to go. And so that happened here and here. And again, we milked. That's called shearing the meat off almost all of the bone. Same with that trade there, right? And then we even went long the lows there last week, 2 weeks ago. And now we've just come full circle. This is a bearish rising wedge. The same one I just gave to you this morning on the 5-minute chart. And that's the same comparable support level I give you on the 5-minute chart. It's just here on the 60. And that is also a divergent high. I just need to borrow you, duplicate you, and put you there. That's what this is right here. Divergence is prices. Negative divergence are prices on a security making higher highs and your indicators making lower highs, just like you had a divergent high there. We got that counter trend bounce we gained, reshorted right there. So we juiced, the whole drop. If you followed those trades, I posted active trades during that period, we made a lot more than the market actually fell, and even got a juice to gain some of the bounces in there, including that end rally. So there it is. That's it. So time to go down. And guess what? The good news is, even if I'm wrong on that, hopefully I'll be right on many of the other trade ideas. I keep them coming, mix of long and short trade ideas. I'm going to update UNG next, only because we're getting close to the next target here. This is a trade taking a little longer than it usually does play out. This was our initial entry on the bullish falling wedge breakout. We hit my first target there. We hit it again, finally broke out. That opened the door to hit my second and third targets. We had some divergence. I will point out we have divergence here again, but natural gas, we're coming off a much bigger bullish divergent low. And so I have given you, these initial targets for swing trading time frame. We're coming up again on T4. That's going to be a 32% gain for you, probably even more in futures. That's my proxy. I like the futures, but you got to roll them and all that, and then it gets pain. The charts could, on the platform I use, that contract cancels out. All my annotations go away, and I have to replicate the chart. The levels are different on the futures accounts that I'm using, but there it is. And then long term, I've given you some long term targets, which I still maintain. And if hit, from the wedge breakout, it's going to be about a 150% run. We did the same thing last year here. It was a lot more on the futures. That was a trade we actually entered right at the low last year, 2024, and hit to the exact cent. It was uncanny. My target on the futures, and it was in a Sunday evening trade. And like I like to do, I got it out to you that evening to exit and turn around, reverse it short. So not only did we game that whole thing up, we turned around and were able to profit additionally on shorting. So like any trade, is either going to pan out or not. So you do you. You have stops commensurate with your price targets, your entry points. They're all going to be different. Like the NQ trades and everything else. There's entries, exits. I post active trading opportunities, but I always try to talk to the swing trader, the trend trader, and the active trader. And they're all on different time frames. And so at any given time, it's not unusual. I might have long-term accounts where I'm IRAs and things. I'm long a certain stock or index, but yet I'm shorting it in my active trading account for a quick 3-4% pullback, right? That's active trading. So please, I make it as clear as I possibly can in the post. But if you look at a chart and you see a 5-15 minute chart, please know that's not for the long-term investor or trend trader. That's just the active trading stuff. Okay, so that's it. We're coming up on T4, which I expect will probably be hit today. TLT hit the third target yesterday. I was going to get that out to you, but it's just, I'm not in this anymore. I've lost interest in treasuries, but I still maintain we still have this fourth target here. Was always been the first of, since we shorted this thing. Where was it? T1. Well, created back on 1022, 1112. I'm sorry, 1022. 1022. Okay, so we shorted it on 1022. Where is that? Right here. Okay, yeah, we nailed it. So we shorted right here. That's why I laid this trade. I gave you 1, 2, 3, and I may have added this target afterwards. But we hit T3. I just want to point that out. And the bounce has been muted so far. T4 is still down here, the first of this level, or the trend line. And my point is the trend line is going to come in first at this point in time. So that's most likely where we're going to have a reaction for those of you still short treasuries. Bitcoin, I think I conveyed my thoughts pretty clear, so I won't spend a lot of time there. That was 60-minute chart on the daily. I got confused. So we had 3 targets, and I decided to remove T3 today. Again, we could, I was pretty clear there before. Coin toss odds would go up. But the way my brain works is, okay, you give me 50-50 odds, and we can sit here and flip a coin all day. I give you $1. If I get tails, you get $1. If you get heads, right? So we can do that all day, and we're just throwing money. That's equal odds, right? But I like trades with favorable odds, and then I look at the what if. Again, if it just doesn't smell right to me. And again, I've told you all along, I've made it very clear, I'm not looking for the bottom, just a bottom. And we got that so far. And again, so is it worth it? The way I look at this, is it worth it to hold out for another 5, less than 6% and risk a sudden reversal? Because I do believe Bitcoin, I believe this is just a reflexive bounce off support. And like I said, the problem with it, if you trade futures, really no problem. I love futures for many reasons. Tax benefits, that ginormous 60-40 short-term, long-term capital gains taxation, or long-term, short-term, and the fact that they trade around the clock. So if I'm trading Bitcoin futures and there's a huge move overnight because one of these, anything happens, let's just whatever reason, I can have a stop that's going to be hit, and I don't have to wake up to a big gap down. Now, if you're trading those proxies I gave you, that is the case. You could wake up to a gap down that bypasses any well-placed stop. So, on all these, we took them right off the lows. That's where I threw them out. Made a point to get them out to you before I could even mark up the chart, so it wouldn't take me 30-40 minutes. And so quick, easy gains, easy money, and 35%. Why hold out, for that additional? Again, you can do it. It's up to you. I let you know on Friday morning. I took them all out on Friday. That's why I got the post out to you. And I've told you I'm kind of just watching, trying to get, a feel. And I may change my mind again, guys. I may go back into these long again, but right now I'm just not feeling it. And that's support if we pull all the way back to T1 on Riot. Coin, we already hit T1. We hit it again. It's giving you another on Friday. All these were hit on Friday, the first or second targets. MAR, you're there again. So it's, giving you another opportunity. And again, I can 50-50 chance if they go up to those next targets. That'd be pretty nice gain. So there is nothing wrong if you are bullish. It's just me being a little cautious, a little harvesting some profits. And again, which I did on Friday, but officially I took off Bitcoin. And it's semantics whether you want me to officially remove these or not. I just have to put the posts, mark up all the charts. My thoughts were conveyed out there in it. So yeah, that's it. So I've shared with you already the that's Bitcoin futures. Where's my? I just don't have enough evidence for a bottom. If you wonder why, and again, based on my projection, looking at these charts, what I see here, this is Bitcoin, the actual crypto. Here's our BOD or benefit of the doubt trend line. That was the initial trend line that was broken there. And this is just a breakdown and a back test, and this is really nice support, which I think is likely to be hit, and that's also a minimum target. So that's one reason why I think we go down. All right, so let's move on. If you have Bitcoin or any of those proxies, there's nothing wrong. Just trail up your stops, and and if it does reverse, maybe you won't be bypassed on a big gap down. I'm just saying that's a possibility with volatility, especially in Bitcoin and these stocks being high right now. Not necessarily the market, although that can return quickly, as you do know. We've got that seasonality thing going. So like I told you, I put 50-50 whether the market's going to drop much before the end of the year or get the Santa rally. Again, it's liking the weak job numbers today because that just locked in the rate cut pretty much. That's what's going on right now. But like I said, market broke down today, so made an objective case to short the NQs. Oh, and if you missed it, guys, I usually do this often. I posted note right here. Several charts after that first one I got out to you in pre-market. That was the initial chart. Then I followed up. And again, if you're interested, so if you're an active trader, I'm not going to send out emails on these active trades every little zig and zag. It's just going to pollute your inbox and mine. You can come in and check under that post. And so there, there's a sell signal triggered, boom, fired off, screenshot. All these things are always time stamped, all these charts. First target was hit. And I still think any reaction is going to be minor and fleeting. So far, it's been a minor bounce off that level. Brief momentum fueled overshoot, but we've bounced. I just started and showed you that chart already earlier in the video. And then for the small caps, here's a setup as well. RTY or IWM, which is the ETF for the Russell 2000, sell signal to come on a break below this 2467 support. So this is another setup. It's still untriggered. As I like to say, support is support until unless broken. And I got that out to you before we even hit it. We hit it again. And there's just a great example of be patient, wait. You might say, oh, Randy, I love this active trading thing, but I'm not in front of my computer all day. There's two options. You can either set what we call a sell stop order, where it'll automatically sell at whatever price you want. You want to put it at 24.65, whatever you want. It'll sell if the price of this futures contract, or you could use IWM, goes down there. I gave you one sold target for the time being. And the other thing is just almost every broker now gives you chart trading tools where you can just mark your support level and then set an order. If the security breaks that level, you can even say by a certain percentage point, 0.5%, whatever you want, if you want to give it a little margin of error. I like to just have eyes on everything to make sure if we break through, it's not going to be a whipsaw. What might where might it prove to be a whipsaw? Well, the support held here, so first of all, there is no whipsaw, but at the same time that hit, NQ had hit my first target here and bounced. And so there's only one option to do at that point. Either cover short or go long for a bounce. You don't short a drop into support. You either go long or cover a short. or you wait for support to break and then you short. So you need now today's lows pretty much on NQ and also on RTY, which is the same as IWM. Again, if you're a ETF trader, use IWM. Okay, I just fired off Shopify for you. I just want to share this chart. I kind of circled a little bit. I had to zoom in here so you could see everything clearly. Basically, the justification for a short entry, we broke down from this most recent bearish rising wedge pattern here on the daily chart. That is complete with the requisite negative divergence. And there's a nice clean uptrend line, broke down. There was also some price resistance there. And so while I missed that initial breakdown, that's fine. I can see we kick back to that same level now. And, it's a little bit higher. But either way, I like this one. And if you look at this chart, this is a daily chart. Again, I circled this on the what I got out to you. It's a wash, rinse, repeat thing. You've had over the last, this is as far back as I can scroll on my daily chart. I can't go back any further. I count 1, 2, 3, 4, 5 divergent highs. From that divergent high, we dropped down 86%. From this divergent high, we dropped down 37. From this divergent high, we dropped about 46. From this divergent high, I got to start low, I'll go a little lower, we dropped about 46. From this one, we've dropped 26. So something's not meshing there. What it is this to me is most likely appears to be nothing more than the first counter trend bounce. There was a nice big gap there. That is our first target zone. It would have also been had I put this as a short trade here. So we would have covered there on that first one, game the bounce. But it's already been checked. So go back down now. My preference would be to cover at the bottom of the zone, but you also have the 200 coming in right there, 200 exponential and 200 simple. So if we get that, this is how this trade should play out. Drop of about 18% from where we shorted today, especially if the market will cooperate with us and go on down to those targets I gave you on the short-term chart of QQQ. Get that 18%. Again, assuming that the market is poised to bounce, it will help. Maybe game a bounce here, or not. If the market's melting down, we'll probably just go right through that first support level. Either way, I've given you 4 targets and a max stop. Max stop would assume you're holding out for the prize, which is the final current target. Gives you a nice RR. You make, if you hit T4, you're going to make, and you just tuck it away, 42%. And if you get stopped out, that's less than a 12% loss. So that's well above a 3-to-1 RR ratio, a risk reward ratio, meaning you're going to make over 3 units of profit to risk 1 unit of loss. And again, so if you're only targeting these guys, you want a tighter stop. But let's look at the weekly chart of Spotify, which trust me, I do. I get trade ideas out to you. I'm usually only going to show you one time frame. But I analyze multiple time frames. And Shopify, you have a secular bull market uptrend line that started shortly after the stock came public. Back in 2015, it came public. In the beginning of 2016, we had a major low. There's your primary bull market uptrend line. That is a longer term target that I believe will be hit. Why do I believe it'll be hit? Well, wash, rinse, repeat, guys. This stock has a pattern of making these rising wedges on the weekly chart. With double tap, what I call it, divergent high 1, correction 1, and that first correction's well into the double digits. Don't get me wrong, I'm using log scaling here on a weekly time frame. Those are big drops. It's the second one that usually does a trick. When we broke down, back tested, and dropped. Just to measure it out for you, that was a total drop of 30, almost 28%. Divergent high wedge break dropped about 31%. Divergent high 1 here, double tapped again. Divergent high 1, correction 1. Divergent high 2 finally took out the trend line after that. And from there, the total drop was about 85%. And so now this pattern here looks almost identical to this one. Scope of the wedge, it's a little steeper slope. Breakdown, little snapback rally. And so these are my weekly targets. So that would give, if hit, On the weekly time frame, the first target's going to be about 26%. And then the second target, which is that lower trend line in this 90-40-ish level, that's about a 44% drop. And honestly, I think that's conservative. I think a lot of stocks are getting to the point where they're threatening and may take out those secular bull market uptrend lines next year. And if that happens, then this, what I just called for is simply a correction in a bull market. You might think I'm overly bearish, but that's bullish. If it pulls back there and you get a 50% drop, it's the nature of this beast. This is where, you get one divergent low right there, nice, beautiful divergent low, and that gives us this whole rally. But if this longer term trend line breaks, then that's going to be even more bearish. Remember, this right here, this 87% drop in Spotify was simply a correction, if you will, in an ongoing bull market. So don't underestimate just how far a lot of stocks are going to drop when we have the next bear market. And if you're drinking anybody's Kool-Aid that bear markets have now been banned and prohibited by the Fed, yeah, they were doing that for since the financial crisis for the most point, 2008. They figured, we'll just keep printing money, we'll keep doing quantitative easing, we'll keep rates at zero because guess what? There's no inflation. We're golden. Inflation's a thing of the past. Well, they got checked on that, and so they've now lost that ability, and we're all very aware of that. So either way, there's Shopify kind of from a long-term and shorter-term perspective. We've got a couple more for you, and we'll wrap this up. IRDM, Iridium recently broke out of this bullish falling wedge. Volume's not there. To be safe, you want to see it take out this BOD level, benefit of the doubt, 1718, and because the thing is, breakouts that occur on below average volume, there was a little bit of spike on the breakout day, but those have a higher rate of failing, and this thing's clearly in a bear market. And either way, so my targets here, that's more so the first resistance level, not the first target. It's about another 2-3% above. This target here, the first one, 1836, always sell a little bit below that. That's the actual resistance. That'd be about a 9% gain and about 18% up to this 1988 target. And if we are going to enter, if the stock market does hold up, through into next year, into next at least the first quarter, yeah, maybe this thing comes all the way back up here, maybe to another run at the 200-day moving averages or that $25 level. So just one I wanted to float out to you, CERS. Another one, CERS Corp, medical devices company, beautiful downtrend line. I just picked up on it today, or I would have shared it with you earlier. Took it back its 200-day moving averages, but it has a history of doing that. It's had a couple times where it tried to regain them and couldn't, kept its bear market going. But now it's clearly, it tested, back tested, it's starting to walk away, and more importantly, it's taken out that downtrend line. So again, I'm sharing this for those looking for long trade ideas, and I would say these are your first two targets. Look at these reaction highs right here. So if hit, that gives it another 13 and 30%, 31%. All right, SFL, I think I already got that one out to you today. Yes, I did. I give you some pretty clear notes on that. Downtrend line, a lot of stuff to note on this one. You got a primary downtrend line, the 200 exponential, 200 simple, which it's testing now, and then 850 price resistance. So like I said, you could take a starter here on a breakout of the trend line in the 200 simple and or add. That would be my preference. And then you have a full position if that gets taken out. And then I've given you 3 targets. Your stop will be based on your average entry price should you decide to take it and your preferred price target. I'm going to hit on Carvana because it's holding up. The market seems to be, it does. We're not too far off highs, so we remain in risk on mode. Carvana is pushing that initial stop. Remember, Carvana, we shorted it. Oh, God, I'm trying to remember. I think here we hit my first target, hit my second target, and the 200-day moving averages, and we bounced. I have a stop on a close above 400. You might want to make that on a weekly closing basis. Would probably be the safe thing to do. I'm just going to leave that there for now for any of you in it. It needs to take out this trend line to trigger another short entry. I think I shared that with you the other day. Here's a minor uptrend line. And so what tends to happen is the nefarious powers that be, the nefarious forces in the market, those old school market makers, algos, trading desks, when they can get you up near there, those previous highs, they usually like to pop it. It's called a stop rate, blow out all the stops on short sellers, and then resume the downtrend. Any new high anytime soon will still be a divergent high. Big. This is my weekly chart on Carvana. Big negative divergence. That was so far the high, but if we make a marginal new high, it's only going to extend these divergences. That is a guarantee, a 100% guarantee that any marginal new high, and we've already broken the primary uptrend line, it would just be a back test. So I'll probably extend the stops on that one. Again, I've given you long-term targets too from last year. It's just like the stock market. We shorted somewhere in there, hit my first target, as you know, on early August 6th, time to cover all shorts, go hard long. And so it's just a continuation trade, if you will, from longer term perspective, that is. Not that, what kept it on as an official trade, but these are long-term targets. So that's it. So it's a matter of, do we punch out, make a marginal new high or not? Do we fail below there? T1's already been hit, so that should open the door to T2, 3, and 4. And again, this is just like here. We broke down there, we didn't look back. Sometimes you break down, you don't look back. Sometimes you break down and you back test a trend line before moving lower. All right, so there's your update on Carvana. That reminds me of Apple too, by the way. Apple threw it out as a short a couple weeks back. And I made the stop on a weekly close above, what was that level? 273, and it's still that 279.33. I think that's where that's at. I probably wrote it in the post, and we haven't closed above that level on a weekly close yet. A weekly closing basis, that would be this is the Monday's candle, Tuesday. So we'll leave that stop there. I don't like the price action Apple. I wouldn't add to it right now, but nothing, and I repeat, nothing's changed. I still maintain these targets. These are just initial short-term, relatively short-term swing targets. The divergence has only gotten larger, and on the weekly chart, you can see here, we're still riding up this weekly trend line there. Big negative divergence, and I've shared this chart with you so many times in the past, but I'm going to do it just real quick here. Got to move this one. I need to move you up here. Divergent high 3. This is another extension of the divergence. This is divergent high. What I'm going to show you here is Apple. I'm going to circle all the divergent highs I have on the weekly. Again, I've done this many times for you. And circle the corrections or bear markets. This was just an extension, DH2, 3, 15, 16%, another divergent high, 45% drop, divergent high 32, and ultimately ended with 34% drop. Before all said and done, that was positive divergence, aka divergent low, bullish, set us up on the next rally. Divergent high 39% drop, divergent high 35, 21, 32, 35, and again, this is just an extension. This is the biggest divergence Apple's had in pretty much in its history. You can see here that was a divergent high back there, and .com bubble dropped 82%. This is a monthly chart. You can see the same things here. These are all the big drops in the cyclical bull and bear markets, and Apple's been in one fat, like a lot of things like the stock market, one big fat secular bull market, but it broke that trend line recently and has been back testing from below. This is my monthly chart. All right, so like I said, negative divergences, even larger than those leading up to the start of the 2007 to 09 bear. So again, this is what formulates my long-term outlook and tells me that Apple is going a lot lower in the coming years, despite what happens this week or next, right? That's shorter term stuff. So we'll see. I just wanted to give you an update on that one in case anyone's in it. I haven't heard any requests for an update, but that's it. I haven't changed anything since the last update, which is still that, if it can rally, drop back down through there, and up to you if you want to extend that a little bit. Like I said, the technical posture is the same. Apple's not going to drop much or at all unless the Qs drop. So it's a very, very, very much overlap trade. It's like being long or short NVIDIA, and then also QQQ. They're going to go because Apple is the second largest component in the NASDAQ 100 and S&P 500, right behind NVIDIA. It's the second largest market cap behind NVIDIA. Okay, that's it. I mean, I'll wrap up. I'll just tell you the one thing holding this market up is the financials. They came, tested that key support level. I need to see go and the 200-day moving averages, which come in below, and they're hanging in there. They're rallying on the expectation of the rate cuts, and they're off their highs. But this sector needs to break because it is the second largest sector in the S&P 500, and so tech's gone through a little correction lately, and this is what's buoyed the entire rest of the stock market, in my opinion. And again, it's mathematics. It's not too big of an opinion. It's the second largest sector in the S&P 500. All right, guys, I'm going to wrap it up here, get the video out to you, and if I see anything else, I'll follow up. If not, this might be the only video of the day. This has been Randy Finney with Right Side of the Chart. Have a good one.